All right, all right. What's going on, everybody? We're halfway through the week. Not too bad. So far, it looks like the morning briefing analysis is holding up pretty good. The base case for today was that it would be pretty nasty if we stayed inside of yesterday's range. And it does seem like that's the kind of behavior that we're looking at. Yeah, that's a really good question. So, as usual, when we do these afternoon chats, it's always open for topic requests and all that. And of course, earnings are a big part of everything that we do. And so the question tends to come back around from time to time, especially during earnings season. And over the years, kind of got to the point where I'm pretty comfortable with my take on earnings. The idea is if you want to trade earnings, you really need to have earnings tools. That's the long and the short of it, right? That everything we do as traders, there's probably something out there that helps us do that particular thing better. Stocks, options, futures, day trade, swing trade, investing. So when it comes to playing earnings, you know, if we just kind of kick back and think about it for a minute, there's probably an earnings company out there. Two of the biggest ones is Earnings Whisperer and um, Whisper Number, which I've always kind of felt like Whisper Number was trying to hijack Earnings Whisper, but so if you want to trade earnings, it would really help if you've got the depth and the background of the decades of research that's been gathered and collected about the various ways that traders can really approach earnings, the lead into earnings, the report itself, and then the way that we leave earnings after the report. There's a lot of historic data and a phenomenal amount of research that has gone into it that really provides insight into clarity and your opportunity versus risk, right? Without this sort of depth, trying to trade earnings is about as useful as going to Vegas and just pulling the slot machine lever. You're just gambling. At least in Vegas, they give you free drinks, right? So if you want to trade earnings, you got to have some edge in it. So this is one of those companies. This is another one of those companies. Hold on a second. I can't type and talk, and I need to type something out. So give me just a second. All right. We'll let them reply and then figure out there. All right. So for the earnings question, this those two websites are going to be key, right? Now, watching the move happen live, every broker's got an issue with that. So you can hunt around and you can try to find a broker that can do the job better, but it's violent data and everything's hitting all at once. I personally don't try to trade the after hours, so I don't know what broker's gonna do it better versus another broker. You're gonna have to maybe do some online research, talk to people that are trading earnings in the after hours or in the pre-market, see what they're using, maybe get some feedback on them if they know one that maybe doesn't lag when all that violence is hitting the chart. That would be the best I can tell you because I've never had any interest in trading it. So I have no idea what would be a better earnings broker for the report in the after hours and in the pre-market. I know that when I was looking into trading earnings myself, the run up into an earnings and the move out over the next few weeks after the report, that became my approach to trading earnings. And when I found these two companies, by the time I was done researching their material, I I was a completely different trader at the end of that. I had this oh, expectation isn't really the word, but I had this idea of what earnings trades were supposed to be like. And then by the time I got done with their material, I had a completely different idea of what earnings is supposed to be like. And completely night and day. I mean, I'm so glad I did go through this material. I still don't trade the actual report, but I feel like I've got a much stronger understanding of the company's opportunity when they do report and some of the shenanigans that they play because you know uh, they can't necessarily cheat, but there's games that they play. And when it comes to the numbers, it's just games that they can play. So you work your way through this material, and unfortunately, it's not free. Well, I mean, a lot of the stuff they'll lay it out there because they want you to learn it, but a lot of the tools that you would want to use for the report, that stuff's not free, right? But you can get a lot of their education for free as a good starting point. And keep an eye on any sales or anything like that if you want to peek behind the curtain. Or, if you like trading earnings and you're going to make it a really big part of your trading world, then spend the money because it will pay for itself. 100% it will. I think Whisper Number is cheaper than Earnings Whisper. And I hate to say it's you get what you pay for because we know that's not always true. There's some awesome stuff out there that's free. But compare them both. And with the modern world and AI and all these agents and everything, there could probably be an even newer, more sophisticated site that could possibly be cheaper or better. I don't know. These two did really good for me. I can say that. All right, sorry about that. So, um, the other day we were talking about this change in market dynamics, and it's a really big deal. There's a lot to it, and there's so much that we don't know that's coming at us. But I wanted to get some numbers right, and I wanted to really get the progression through history to where we are now to kind of provide some perspective on how big all of this is. So here's a list for those watching the replay. I'll bring this over so you guys can see what I posted. Here's this list, and you'll notice it goes back to the 1800s. There was trading all the way back in the 1800s. Most of those companies that were traded back in the 1800s were actually banks. It wasn't Bank of the United States, right? That wasn't really what we want to focus on by itself, but it was banks back then. That was the largest part of the trading universe back then. Then it swapped over into railroads, and then the industrials, and then energy, internet, and now AI and chips. And at some point, quantum is going to end up on this list, right? Maybe it'll get tied in with AI. Maybe quantum will be its own thing, but at some point, quantum's going to go there too. Now, if you've worked your way through history in just various forms, you'll probably understand that how many states we have as a country, the borders of those states, the nation as we know it was built around the money spent by the railroad companies. Some of the world wars that we've been in, and just other wars, not necessarily world wars, but wars that we've been in, and even headlines still today deal with the energy, right? Countries that had oil, countries that, wasn't playing ball with us when it comes to their oil. Energy's been a really big deal. The Mag 7 has been dominant for a while, a long while. And that dominance is changing, and software as a service is getting disrupted. And there's this change in perception from the idea that AI would enhance our software and make things better to this new idea that AI is going to destroy software as we know it and kill those software companies. That's really been shaking the foundation of the market in the last week or so. People are kind of freaking out, like if you can get an agent to come in and do what you would normally buy a software subscription for, and it can do it cheaper and faster and cleaner with less errors, well, then that software company just has no reason to even exist. And that's going to grow, right? That uncertainty. There was this great article that I was reading. This is from Macro Micro, and it's talking about these software stocks are in free fall, and it's been that way for a little while now, since October. ServiceNow and AppLovin and Unity are three of the names that I see tossed around quite a bit. Just gone, right? They're not quite gone yet, but they're going to be, because there's no reason for anybody to pay for their services. They're talking about a $100 monthly subscription using something like Anthropic's Claude or Google with his Project Genie. And then you wouldn't need the thousands of dollars that you would normally use on Thomson Reuters or Relax and LegalZoom. It's madness, right? So there's some stuff that I can copy and paste. Like I shared some of these images earlier. But the idea is that things are in transition. And so, from a trade point of view, no problem, right? Because we're just talking trades. You're nimble, you get in, you get out, you got opportunity to be flexible. But for your long term buy and hold portfolios, that is something that is going to really require some adjustments along the way, right? And not just yours. Think about the company you work for, the the biggest names being held by most retirement accounts. It's going to be a seismic shift when this narrative really starts to pick up speed. So I just wanted to throw it out there. There's 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 a lot that we don't know. It's still unfolding, but we know enough at this point that we need to be cautious. And there's still a direction for us, right? Memory stocks like ScanDisk and Western Digital, they're still booming pretty good. So, let's just turn this into a PDF, and I'll put that in the chat. And that way you guys can work through it at your own pace. There's no rush. All right, now we've got some uh, economic events on the calendar that are coming up that are worth considering. Now, last year they took a front run on this and it kind of took off a little bit early. If you're looking at China stocks like JD, PDD, Baba, Baidu, even the EVs, right? Neo, XPEV, those guys, you want to pay attention to the government body in China. And every year they do this really big event in the front part of the year. Last year we were stalking them, waiting for it, and they jumped the gun like a week and a half early. So this time, rather than waiting until we get closer, I want to warn people kind of a little bit ahead of time so that you know what we're looking for. So it was right in here. The the third week in January, we started to pop and ran all the way up into March. Now the event that's coming is in the late part of February, but like I said, they jumped the gun. They got it early. And it's not like that was the run for the year, right? We stalled out and then we ran back up and tried to get a little bit more. But with all the tariffs and everything focused on China, they really had a tough time last year. So hopefully we're past that, right? Hopefully we're not going to see a bunch of tariff talk like we had last year at this time, and we can focus more on how we're going to come out of it. So we've been in this downtrend. It's pretty clear. What I'm looking at is the KWEB group. This is an ETF. If you're new to all of this, an ETF just means a basket of stocks. So we're looking at the China Internet ETF. That's what this one is. It's not the entire index, but it's just like how in the US we focus on the Mag 7 because they're the dominant ones. Well, the names in this ETF are pretty much the dominant names in China. So you could go in and individually pick and choose, but when you're trying to see how's China doing, using this ETF is a good way to go, right? It's generally what I use if I just want to see how's China doing today. I just look at KWEB. But it is not the whole index, just like looking at the Mag 7 isn't looking at, SPY or the Qs. So it will leave you blind if you don't look around at other stuff too. The expectation is that we're going to hear good things from this event that's coming up. It's often called the two sessions, starts on February 27th. One is the National People's Congress, and the other one is the Chinese People's Political Consultative Conference. Blah, 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 all of that good stuff, right? So those two are both going to be kicking off their session in the late part of February. And it will directly affect Baba, Baidu, JD, PDD, all those guys, right? The KWEB constituents. My warning or the message I want to get out there is while the event starts on the 27th, watch for them to kick it off a little bit early because of course they're going to front run it. They talk about it inside their own country. They cheat like crazy. There's no such thing as insider knowledge or insider information over there. They just do whatever they want. So watch for that. And their government will subsidize different companies. They pick winners and they pick losers and who they're going to lean in to help and who they're going to restrict. They adjust policy as they see fit. But those policy changes and those subsidy values, how much money they're going to give to different sectors and different parts of their economy, is going to be announced in this late February event. Now, it's possible that they're going to rein in and throttle the growth that they've started to build on. It's possible. They've done it before, but I'm really kind of expecting them to lean into it and push this expansion farther. They've dialed back their trade with us from 20% to 10%. And yet they're not suffering because they're still doing trade with nations all around the world. They're just not exporting to us in the size that they was. And I think they're going to lean into that and they're going to continue to push those exports, just not to us. So that should really help Baba and Baidu and JD and all those guys. I think we got a pretty good opportunity. But it's hard to see an opportunity when it looks like this right now, right? I mean that's a heck of a beatdown. There's no setup, no signal, no pattern, nothing that makes me want to go long here, right? Now this is JD, it's just one name. Then you got Baba. Let me turn off my log chart here because it skews things. That's more better. More better. All right, so Baba, we've run back up and tagged this halfback. We're kind of struggling underneath it. If we can get back up through that 190, then we could complete this big old cup. My concern is that we're not going to be able to get back up through that 190, and then we're going to fail around that 200, and it's just all going to come crashing back down again. Maybe a bit like PayPal. We had high hopes for PayPal on that base that it had built down here. Let me just erase the part that gives away what we ended up with. When we started with this, that was looking pretty good, right? We had set the low, we were holding higher than that low, we started to climb higher than this high. Everything looked good. And then it just fell out of bed, right? So now PayPal hadn't even made it, above 786. Certainly it didn't get back to the half. So Baba's doing better than PayPal simply because it's already back to the half. Just going to flip this over here so we got the numbers moving in the right direction. That way we get that 786 down here where it should be. So my recommendation would be to scope these guys out. Make sure they're a part of your daily watch list. Get familiar with their options. Choose in advance which ones you think you might want to trade or which ones you're really sure you don't want to trade. Right? Like I'm really picky. When it comes to options, if a company doesn't have what I'm looking for, I'm done. I just leave it alone. I just don't care. Right? I won't force the issue. So I'm really confident when I go in and I look at the options on whether or not I want to trade something. Well, once I've decided that I don't want to trade it, I'm done. I don't want to waste my time looking at the chart, watching headlines, reading about it. because I already know, screw that thing. I'm not trading it. So you could save yourself a lot of time and effort if you start with, am I even willing to trade this name? And if you're not, just scratch it off the list and then you don't have to mess with it. Baba right now is looking at some pretty thin options, all things considered, right? It's pretty thin, but only if you're going out to the next monthly expiry. If you're keeping it in the front month expiry, it's not that bad. So it just depends on how nimble you are. Once we're done with this February 20 expiration, the March expiration is going to start to get more of this sort of volume. So it's just keeping you in the front end, right? At least it's keeping me in the front end because this is not tradable, but this is tolerable. $2.50 wide strikes. The bid ask is a bit wide, 20 cents, but it's 4 digits on the volume, and I can find 4 digits up and down the options chain. So it's got a lot of participation. The problem is you really got to stay in the front end, right? If you try to expand out here, you can't find anything tradable, at least nothing that meets my strict criteria. So maybe some nimble opportunities in Baba, but not the bigger kind of buy and hold plays. Plus, it's a bit expensive. So I already know I wouldn't be selling puts in this one. Maybe in like KWeb itself, because it's less than 40 bucks, I might consider something like a naked put, but not in this. I wouldn't want to do it. So we got Baidu, another stock that's over $100, even less liquid than Baba. We're in the front end and we don't even have triple digits, right? One strike that has triple digits. All the rest of these are just doubles and singles. This is an illiquid turd. It's nice that it has $1 wide strikes, but that's it, right? It kind of stops there. So, as much as I would like to trade Baidu, I wouldn't trade Baidu because this looks like trash. I don't want it. I already did mention KWeb, so we'll jump over there and take a look at that for a moment. It's less than $50. It's got 50-cent wide strikes, 4 pennies wide on the bid ask spread. Now, that's not bad at all, right? So it's a way to gain exposure to Baba and Baidu and JD and all those guys. Um, my preview here shows the website, but that preview doesn't get refreshed. So you guys should be seeing my Think or Swim. Let's try that. So I'm willing to trade the KWeb group as a way to get exposure, simply as a way also to avoid the illiquid trash like Baidu. And it doesn't get much better, right? If you shop around and look at JD and PDD, it's kind of hit or miss, but most of them are illiquid as hell, right? Like PDD, triple digits, double digits, there's nothing here. It's $100 stock with $1 wide strikes, 10-cent wide bid ask spreads. I don't want any of that. So KWeb is likely the way to go. It'll give you exposure to those names without having to go in and individually play them. It's cheaper, right? It's $35. So you can just straight up trade the stock, sell puts, whatever you want, right? It is still a little thin. You can look at the strikes. We got triple digits on some, and then, like this 35 half, there's nothing there, or 36 half, there's just nothing. So, there is no volume on those puts right now. But we can even step out a month and we can still see a lot of good volume, great open interest, $1 wide strikes, 2 pennies on the bid ask spread. Like, this is tradable. So the event is going to kick off February 27, and they might front run it like they did last year. Last year, they actually started in January, and obviously they didn't already start in January because we're already in February. So they haven't done that yet. But if they're going to kick it off early, like they did last year, then we want to be watching for that opportunity. It's not necessarily going to be an up move. Keep your eye on the headlines and see if there's uh, any articles that talk about where they might be leaning. They've had issues with real estate. They might crack down in that sector more. Um, they're on again, off again when it comes to Nvidia. Right? First, they said they were going to blackball Nvidia and they wasn't going to let their companies use it. And then they decided, okay, yeah, some companies could use it, but not others. And then they were promoting their companies to use Nvidia chips. So who knows with that, right? But don't think that it's automatically going to be a long. That's my base case, is that it's going to be a long, but I don't know, right? We want to look for those headlines and prepare some lines in the sand for where we going to go, what we think it's going to do. Let's try to split things up here a little bit. That's the low. Missed it. That's the low. And that's the range top that we was in for a while. Let's kind of tie that to something like this gap close here. This is an anchored VWAP. We want to use last year as the start point. We don't need the bands, so we'll just turn those off. All right, we're under the year-to-date anchored VWAP, and that's last year's anchor. The reason we want to use last year's is because if we use this year's, we've basically only have January. And there's nothing wrong with that, right? Just using 1 month of a VWAP is okay, but you still want a full anchor, a full year. Now you can also run an anchor from earnings or big gaps or big volume spots. That kind of gets into a little bit of wishy-washy and picking your spots, and maybe depending on the platform you use, you can decide where your anchor would go because it'll be built into the indicator itself and it'll auto anchor to those places. If you're going to do it manually, there's a really big volume level from October 10. That wouldn't be a bad place to start an anchor just because it's a high volume location. Of course, we're underneath that too, but whatever. And then we've got a big gap here on this dividend date. We could do that one, but that's December 22nd. And you're better off just using, say, um, a start of the new year, right? Year to date is what I was looking for. Use a year to date anchor, and that would be starting from January 2 of 2026 to now. And we would be underneath that one too. But I think these two are pretty solid. They are what I would use. And those are just levels overhead to be mindful of when we start that break back in the other direction, that we're going to hit those. There's our Linreg line. Now that we've snapped it, we can redraw as a channel. Kind of highlights for us the channel top and the channel bottom. And you can see more clearly now how we're dancing here around the middle. Me and this pin are going to go around and around. It's like it just gets tired in the afternoon and it doesn't want to work anymore. My pen is a union pen. It only works when it wants to. It takes a lots of breaks. So we're tangled up here around the middle. Kind of an IX10 pattern. We stalled on this move down and we didn't get back to the next low. And so that leaves us in this little bit of a disposition area. Under 33, I think we get back down to that 31, maybe 31 and a half. And back up above this high, then we can take out 35 and get into 36 and that year to date anchored VWAP, or not year to date, the last year's VWAP. I got to say that correctly so that we don't label the wrong one. Okay, go away. So at least you know where to be looking, right? This is the KWeb ETF. You could pick the stocks out if you're not as picky and you don't mind the trashy options. Otherwise, I think this is probably the best way to play it. Now, you got to get used to the way that this thing moves because of these gaps, right? This is a gappy booger, all over the place, just gaps like crazy. And that's because it's getting a lot of trades done in the overnight hours while you're asleep. So you have to be careful with your stops if you're a stop kind of trader, because these kind of gaps will just take you out, right? So that's coming. I wanted to get that out of the way. We talked about that. All right. Um, Trading liquid stuff. I think we talk about this all the time because I'm a bit picky, but I like to trade stocks that are liquid, right? And by liquid, I mean I want options that are liquid. Well, you can run a surge and ask Thinkorswim what's got a lot of options trades today. You can do that after the close or near the end of the day, like around 3:30, 4 o'clock, that sort of thing. But that would only give you 1 day of volume, and it might bring you stuff that maybe had earnings today and had a lot of options volume, but it normally doesn't have good options volume. And then that's just a fake preview, right? It's a 1 day wonder and it's not a liquid options product. So a long while back, we were hunting around at ways that we could solve this problem and not have to spend money on another subscription, right? Because, of course, if you have various tools with different subscriptions, you can find things out there. But the CBOE, these guys have all kinds of data, right? The Chicago Board of Exchange, they work with the government, they work with different brokers, they've developed their own tools, they've got education and software and all sorts of stuff. If you haven't heard of them, you should totally check them out because they've got really good stuff. Same with the OIC and the OCC, great, great resources. But what we want to focus on is this. This is the CBOE historical options data download, and it's free. You can see it. I'm not signed in. I don't even think I have an account here, but even if I do have an account, I'm not signed in. You don't need to be signed in. And we want to look down here because we have to tell it what do we want to download. Well, we want all symbols. Now you could just pick like Apple if you want, whatever, but we want all symbols. And now it's asking, hey, what exchange do you want? Now you can just pick one. It really doesn't matter. I'm going to choose CBOE, but let me show you something. Come back over to Thinkorswim for a moment. Turn on your level 2. And you see these different exchanges. ARCA, OTC, NASDAQ, BATS, NYSE. But that was for an ETF. What if I just grab the option itself? Not a stock symbol, but an options symbol. Now I've got CBOE, Amex, C2, Box, ISE. They're just different exchanges, right? And we don't necessarily need to pick one above the other or try to gauge which one is better. I'm on the CBOE's website, so I'm going to go ahead and use the CBOE. If you want to, you could choose all, right? You could just choose all of them. I think that's overkill, and what you're going to end up with is a spreadsheet that has the options volume from each one of those brokers, and then you'll have to clean the sheet up and remove the extras, right? Like it's going to have Apple 4 times, Microsoft 4 times, Google 4 times. That's going to get annoying really quick. So you could choose all four, or you could just choose one, right? Now, after I pick my exchanges, I've got to determine what am I looking for. Now, me, I want 1 month worth of options volume. Because if I just wanted one day, well, I can do that on Thinkorswim. I don't need these guys. But I want an aggregate average of all of the options volume traded in the last month on everything. So now that I told it I want a month's worth, it wants to know which month do you want? Of course, we're already into February, so I want January. If it was at the end of February, I might tell it that I want February, but I'll take January of this year. And now it's asking, how do you want to display that volume? Do you want a summary or do you want an average daily volume? That's the ADV. If you're not sure and you can't remember later, it says it right down here. The average daily volume is calculated by dividing a symbol's total volume by the number of trading days between the selected begin and end date. We're choosing January. So if I choose the average daily volume, it'll look at the total number that it gets and it'll divide that by how many days are in that month. Once you've made all of these decisions, you can download the report. And what you're going to end up with is a CSV file. If you don't have the Windows product to open this, which is Excel, you can open it with Google Sheets, right? So you don't have to go buy anything just to be able to open this thing up. Now I've got other sheets that I need to delete real quick just so that the names that we're going to use don't get caught up in what we're about to do. So I think I got, yeah, I think I got them all deleted. So what you end up with is this raw spreadsheet. And yeah, it's popping up saying, hey, we're going to convert this. So, okay, whatever, go ahead and convert it. And now we've got all this data. It's just raw data right now. And up at the top, we've got headers so that we know what we're looking at. And I can already tell you we've got columns that we don't need, right? Like the trade month. I don't need that. Get out of here. Or the options class. Don't care. Get out of here. Product type? Nah, I don't need that. The exchange? We already know, right? We're the one that picked it. Don't need that. So now all we have left is the underlying, which is the symbol that we want, and the average daily volume. The problem is it's not organized, and we need to be able to manage this data effectively. So we need to take control of this. Easiest way to do that is to, after you've deleted the stuff that you don't want, highlight what's left. And don't use the all highlight up at the top. Actually drag your mouse across what you want. There's a reason for that, right? You can do the all, but it's going to bog down your system. You might be waiting for a while. If you just highlight what you want and then hold control and press T, and you'll get this little menu that pops up because we want to convert this data into a table. And say yes, your table has headers, and hit enter. And now you've got a table. A table can be managed, so we can open it up and we can sort things from the largest to the smallest. That's very handy, right? We can do other things with it, but that's the main one that I wanted to use it for because I want all the stuff that was traded the most up at the top. Now, it's a big list, right? As you can see, there's over 1,000 names. I don't need all those names, right? I'm looking for the liquid stuff. Now you could just use a set number and stop there. Say you just want the top 10 or the top 20 or the top 50. But the problem with elimination inevitably is that you're going to eliminate something that you wish you had not eliminated. I guarantee you, it happens to me all the time. I kick a name out, and then 4 days later, I hear somebody talking about that name, and I go look, and oh my gosh, it made like the most beautiful move, and I wasn't looking at it because I'd already kicked it out of my list. I, I've almost got that down to an art, right? Missing out. Yeah. So that sucks. You can pick a number and choose to just grab whatever, the top 10, the top 50, the top 100. What I like to do is look at the total volume, right? So here on Citicorp, Citigroup, that bank, Citi, that's 8,884 contracts. That was their average on the month. Is that good? I got a lot of eights here. Here's BE at just a tiny bit above 8,000. Let's go look at BE and see if BE is good enough. Does it represent what we would want to trade? Bloom Energy. Nah, not really. No. Feel like I just stepped on a Lego at 2 in the morning. No, this doesn't look good at all. 8,000's not enough, right? Let's see if we can do a little better than that. Let's roll up to 10,000. RGTI. That's a familiar name we're all probably have heard before. $10 wide on the bid ask spread. Really light on the volume for March. The front end isn't that bad enough, but this is one of those really cheap companies. I should have chose something that wasn't so cheap and so new. Maybe something a little older, it's been around a little longer. So USO, that's an institutional favorite. NVO, yeah, let's use that. I think that's a nice representation. NVO, that's that GLP-1 drug, right? It's a part of the HIMS, and Novo Nordisk competes with HIMS and the other guys. Um, yeah, those guys. So what are we looking at? 4 digits on the monthly, puts kind of thin. Open interest looks good, at least on the put side over here. So still not that great, right? At 10,000, it's not that great. Thinkorswim's a little laggy there. And now I'm at 108 names right in this zone here, right? So hopefully I'm kind of highlighting the catch 22 of all of this. If you tighten it up too much and you eliminate too many names, you're going to miss some moves that you might have been willing to trade if you had just seen that it was moving, right? And remember, you can tighten your list more once you get it into your broker. This is the start of everything, right? Like your work list, not your trade list. So how tight do you want your work list? If you use the cutoff of say 100 names, you're going to miss things like Bear, BBAI, or Novo Nordisk, USO, Beyond Meat. Moderna, right? I don't know why SPY is way down there. SPY should not be way down there. Let's rerun this, right? Let's run it the other way. The way I normally would have run it. I chose the other one. I shouldn't have. Let's run summary instead. We're going to do the same thing. I'll just do it really fast. I don't have to walk you guys through it. But we want the monthly volume instead of that average daily volume, because SPY's average daily volume should be top of the list, right? Not somewhere in the middle somewhere. I'll trust the data a little better. So we'll kick that out. Don't save. Get rid of that. Open this one, not that one. Sure, do your converting. We'll get rid of this one and this one and this one and this one. Now, when I said select all, if you wanted to do it, it's that spot right there. You just click that corner. I don't recommend doing it, but if you wanted to do it, that's where you would do it at, right? Just run it all the way down so you get the whole thing. That's 2,000 names, 3,000 names, 5,000 names, 5526. That's a lot of names. Control T, turn it into a table, sort that table from greatest to smallest, and boom, there you go. SPY and the VIX and the SPX and the Qs and the NVIDIA are all at the top. Now, scroll down the list. Here we've got 500 names right there. It's actually like right there because I got a header. That's 500 names. And I bet if we choose that, we would be disappointed by what we're leaving behind. Netflix, Honeywell, DocuSign, Chewy, Gap. Oh, there's so many good names down here. So 500 seems like a bad idea, right? Don't want to cut that off. But it's a lot of names. It's 500 names. So let's roll out a little bit farther. All right, let's go to 700 names. That's an average, or no, a total monthly volume of 13,000. 700 seems like a bit much, right? And that's a little light. So maybe we split the difference. 600 and 50. Wow, take two. Ah, well, 650. It is. But remember, this is your work list, not your trade list. Because if it was our trade list, we'd just go crazy, right? That'd be way too many names. We're going to work this data so that we can narrow it down even more. So let's just capture that 650, right? I'm going to run it back up from that low. Copy it, throw it over into a new sheet. And so that's what we have picked, right? Those 650 names. And it's a lot of names. Remember, if we wanted to just get the most liquid stuff, it stops right at about 600,000, right? So right around here. That's 42 names. You can go with 580,000 or 500,000, and that would get you down to GameStop. 500,000 for the whole month. 48 names. It's not bad, right? So you could tighten it up just by doing something like that. We need to save this file. I want this list, but I don't want it in here. I guess I can do it another way. I want this list, but I don't want it in this document. So we're just going to open a new document just because we want to go over to Thinkorswim with it, right? And I don't want to have to go back in later. So we'll save everything and then I'll just open a new one. This will be just for Thinkorswim. No, I don't want the tour. Get out of here. Now I can close the first one. And we can close the second one after we name it. Now make sure when you're saving it that you open up the drop down menu and choose CVS. Because when you go to upload to Thinkorswim, it's going to require that you have something that it can read. You could do a text document, but you can't use the XLSX, right? You don't want to use that. So choose a text file, or you could just leave it on your cursor if you wanted to do that. But I'm going to do this. I'm saving it as a CVS file. I'm just naming it today's date and calling it a Thinkorswim import. So now we can go over to Thinkorswim create watch list. Import from a file. Now notice it says paste symbols from the clipboard. If you wanted to do that, you could have just highlighted all of those names and been done, right? But I'm going to run it that way. It'll probably pop up with an error for the because it wants to read your header as one of those names, but then you're good, right? So then there's all the names, and it's a lot of names. But now that we've got this list, we know from looking at the data that uh, the average volume stopped at, what do we call it? 60, no, 500,000, right? I think that's what we were running. This doesn't look right. So you'll know for this month what your average volume was, the cutoff point, 500,000, 400,000, whatever it is that you choose to pick. $651 names. And the cutoff for us at 651 names was 15,000. That seems a bit light. We could probably tighten that up. But we got the list, right? It's a lot of names. Now you can take that list of names and you can stick it into the scanner and start cutting it apart. So here it's asking, let me refresh all of this so it's clean. And I should have already shared the website with you guys so you can go there and get it on your own. Options liquidity. Now remember, you can get this on a day-to-day basis if you would want to, but really, I'd say that's almost a waste, right? To get it on a day-to-day basis. You want it like at the end of the month. So at the end of February, you could go in there, or at the 1st of March, you could go in and get February's list, something like that, right? So I reset my scan. We want to tell it to scan in the one that I had just imported, which is February 2026. They're alphabetized. So here's February 2026 raw data. And we want to intersect with weekly options. They should already be weeklies. They're the most liquid, so you would think they're already the weeklies. But let's see. 450 out of 650. So we lost 200 names right there because they didn't have weekly options. We're going to sort these by market cap. And we'll save that list. First edit. Now I took that edit list, ran it back through, and sorted it with things that have 24-hour trading. And that cut the list down to 324. There's our 324 stocks. Now at this point, you could break the uh, ETFs out of the list. That would give you 268 stocks. And you would know that these are the most liquid stocks that were traded in January of 2026. There's a couple of ways that you can dance with this game. But the idea is that that first list that you get from the CBOE, that's your raw list. 25,000 names, I think there was 26,000 names, and that you can cut that list off wherever you like. The only downside to cutting it off wherever you like is inevitably you will cut off a name and then later say, "Oh, shoot, darn it, I wish I hadn't have cut that name off. That made a really good move." So, my solution to that is to make sure that you don't exclusively focus on your list. Because if you do only look at your list, you will miss other things that aren't on the list, right? I know it's kind of obvious, but that's the solution. Not to make your list bigger, hoping that you don't accidentally cut something off, but to just make sure you're still looking at other stuff. So we got 268 names if we remove the ETFs. And from this, we can build something like my high low scan, right? So that things that are bullish will show up on one side and things that are bearish will show up on the other side. And I know that anything that hits my scanner came out of my liquidity list, which by itself doesn't mean it's going to have great options, but at least I know I'm looking at stuff that was the most heavily traded in January, and it's more likely to be liquid than any other names that were out there that didn't get traded heavily in the option space last month. That's the idea. So let's look at some of the names that are on the list. CAG, yeah, that's looking pretty good. We're coming back up into that 200 from the bottom side. That will be a nice short when we get there. The thing about crossing over a 200 period like this is that it's going to take time for this to become bullish and get back up into the high 20s because that 200 has to stop falling and needs to flatten out, and then it's got to rise up. And for the 200 to do that, price has to get above the 200, stay above it, outrun it far enough to make it turn and go up. Otherwise, if we just get there and we chop about, then the line at best will start to go sideways, and that'll be all that it does. Now that was a really nice push in the last month, and we were looking at this last week. We didn't trade it or anything, but we were looking at it. It's about the best agricultural name that you can play, right? If you're wanting to do like dry goods commodities, there's not a lot out there, right? It's not like you want to trade wheat or corn or soy. So I would be looking for a rejection, uh, playing short calls on this, probably with something like a 2022 or a 2025. And look at that. Just not liquid, right? Just not, there's just nothing here. $10 wide on the bid ask spread, $1 strikes. Even after all that work of narrowing down our list and seeing what was the most heavily traded, we found why it was getting heavily traded, right? Look at what happened in the last month. They were hammering this thing all through January, trading those options like crazy, and that's why it ended up on the CBOE list. Yes, absolutely. You could narrow it down with a 10-cent bid ask spread, 100%. The the problem with whittling things down is what we've discussed, right? Is that we'll accidentally kick out something we would have traded. But you could absolutely go in and use the bid ask spread. And that's a really good tell, right? If the bid ask is too wide, it's just going to be a bad trade. You're going to get too handicap. So that sucks. Let's see. There's a question about the Nasdaq. Let's jump over there and take a look at what we've got happening on the NQE. Yeah, I mean it's kind of a rising wedge, right? I wouldn't struggle too much on how the lines line up, but we're already here, so put them on there. Something like that looks decent. So the idea is high, higher high, higher high, low, higher low, higher low. Yeah, we'll call it higher low and higher low. That needs to break. The fact that we're even one, we didn't put in that higher high. We didn't even put in an equal high. We pulled back and we're getting really close to matching this previous low. Kind of implies that we've broke this wedge and we're going to fall down. But I'm going to stress caution here, right? This bar already told you everything you needed to know about the continuation of the move up, that it's broken and that we might be done. But until you cut that one, I made it too messy. Until you cut this, or even at the bare minimum, until you cut this, then you don't have the validation. There's nothing wrong with trading before validation. Trust me, I'm not saying that you have to have it, right? Because waiting for validation just costs people money. But if you're just looking at it from an analysis point, then you want that validation in your analysis. And you would want this lower low to be broken, or you'd want this low to be broken with a lower low. That's the words I was trying to use. Break that low, put in a lower low, and then hopefully we get that lower high too, right? Because we got the higher high and the higher high. So if we break this and we get that first lower low, then we also want to get our first lower high. So we come down and maybe we pop up like this and then we fall even more and we set a new lower low and then a new lower high, right? We start getting that going. I like rising wedges that blow off the top first and then come crashing down. I love those so much more, right? They're like my favorites. But I'll take them this way too, simply because once that range is built and we can't fix the range, then it kind of helps us signal that drop. But I do like it when they blow off top. While we're talking wedges, I've got this theory that I haven't been able to quite nail down yet, but I'm a firm believer, and so I use it all the time. I don't ever want price to get into the last 20% or so. It's not a perfect science, but I don't want it in that last little bit in here. I've noticed that if you have a rising wedge, if price gets in this, it very likely is going to go higher on the breakout and just keep on going. Or if it's a falling wedge, the same thing, right? In the falling wedge, you'll get price, and if it gets into that last little bit, that it'll go down. So I don't I don't have enough examples to be able to prove that argument, but I've seen it enough that I trust the argument. And so when I see price getting into that last little area and then it tries to break down, I won't trade it as a breakdown. I'll actually just kick back and wait and let it show me if I even trade it at all, because it's faked out too many times. And so now I don't think that they're good. I think it's like I think the pattern's broken if it gets into that last 20%. There's a nice little micro range. Be mindful of that 42 channel. So 42.32 is right there. And then of course you got the Nasdaq 50 and the 75 and the 25. That bar is your boss. If we're going to get a fake out, you could run a 111 or a 1236 on that. If it's a fake breakout, then we're going to reverse on that 1236. We're going to come back in again. They're struggling to keep it. Well, that was a nice reversal on the 111. Now you want to see if we're going to get this little pop back up into the 786 before it goes lower, or if it's just going to come back up and try to challenge that half again. Micro ranges are fun to work with. Look at that. What a beautiful breakout. Right into the 1, 2, 3, 6, and then a failure with a lower high, and then the big breakdown. So micro ranges, they work the same way. Doesn't look like it's going to keep it. So that was just a bounce up off the 111 to retest 786. Now it looks like it wants to make that move on down. Don't let it fool you though. Mark that reversal candle's midpoint. Mhm. Bye-bye. All right, let's see what else I had on the list here. You guys got the website now. You'll be able to go and get that whenever you want. I've warned you about China. It's coming up at the end of the month. We started the talk about AI eating the world. Those were the biggest things that I wanted to hit today. So we got them all done. Another rejection on the 111. It's trying, but I don't think it's going to make it. Yeah, VIX has got some juice. The weighted AD didn't get heavy enough negative for us to really break down this afternoon, right? We're holding here around minus 200. Notice earlier in the day we were below that, right? That minus 250 is a really good line in the sand for that AD. You get below that and it's short the market time. But once you get back up below the minus 250, shorts are harder to come by and we struggle with them like the market is struggling here. We're we're under zero, but we're holding out at that minus 200 and that's just not enough. Add the fact that the VIX is struggling to get that breakout and it's been in a range all afternoon, right? All things considered. I mean, we're getting the lower highs and the lower lows, so it was trending down. We're still lower high. So the trend is intact. The VIX is weakening, but not enough. So we can't get a break up on the Nasdaq back up to like 340 and 360 because the VIX can't seem to get that breakdown. But we can't fall down into 260 and 240 because the VIX can't seem to get that breakout either. So if the VIX is going to chop around, it's likely the indexes are going to chop around. The weighted AD is flat. The ticks are flat. We found support at that 500 level. So that's not helping. Yeah, there's always hope, as long as the market's open, there's hope cuz we all know price can do whatever the heck it wants. The problem with analysis is we never have enough, right? Like we can look at dollar and bonds and treasury and yields and commodities and gold and correlated markets, but at the end of the day, there's never enough. So we try to work with what we have, make the best decision that we can make, and we run it from there. Could we run back up? I keep looking around at the things that are left on the docket for the week, and I keep asking myself what's going to be the catalyst or the fuel that would make people want to get long into the end of the week in front of a short week. President's Day is Monday, right? If I have my days right, and the market is closed on President's Day, which means next week should be a short week. Oh, I'm wrong. One more holiday, one more week. It's the third Monday of February. Well, I thought that was the third Monday. It is the third Monday. Yeah. So next week is a short week. What what would cause them to want to buy up the market in front of that short holiday when we've got this Iran risk on the table and uh, maybe and we're still in the government shutdown and maybe even more of a threat. Yeah, that's the third threat, right? So with Iran and the tariffs, it, I just don't I just don't see what would be their reason for wanting to come in and buy in front of that long weekend. But we're holding out right there. This is IX10 inside day with more than one day. So this is the box that we have to get out of. And so far, we're not having any luck. Every time we get into that 25,400 level, we just take a beat down. It's hard to tie all the pieces together with the threats versus the analysis. In the morning briefing, I go over that one chart with the distance from the 10. And I keep thinking every month that we're finally there. It's going to be the month that we get the breakover that I've been looking for. And this would line up really nice with a bounce off of the 50. If we could get a bounce off of the 50, is If we bounced on the 50, maybe we would get that run and we would finally get our distance away from the 10 week to be able to hit 2.5 or 3 or maybe even 3.5 and break this downward spiral that we've been in. But so far we haven't been able to do it. I got hopes. Yeah, I think they've been waiting on a lot, right? Between the Epstein files, that was a big teaser for a long time. And then the government shutdown, we knew that this one was coming when we were making our way through the last one. And that put people in a hurry up and wait mode as well. So there's a lot of things. And then of course waiting on this tariff decision. That's been a really big deal for a while. And the markets had those things in its sights for months. It's not like this stuff just snuck up on us. So it's been just a big, gigantic hurry up and wait scenario. Sucks. That is certainly a really big range. Let me bring that up in the browser so people in the live stream can see it. This was shared in the chat. The if you're gonna run your analysis like this, make sure that you use the continuous contract so that you have all of this volume that's missing and you don't go from nothing to something, right? To me, it always looks really weird. If you run a continuous contract, then you would have all of it, right? You'd have everything. And if you're on Tradeovate, you can still run that continuous contract. You just use the ampersand sign. It's the at sign, right? Right. This is paper. That way, if you see me putting a trade on or anything, I don't know why I would, but if you see me do it, it's paper. So, don't copy anything I'm doing. You got your watch lists, right, on Tradeovate, and you can add those continuous contracts into your watch list, which is nice because it'll sum up all of your volume between all of the various contracts. So you can see I use the at sign there, ES. Now it looks like it's not aggregating all of the volume, it's just running the ES volume. I don't know why it's doing that today. I've done this before and it's run all of the volume. And I'm sure the other contracts are getting some volume today, even if it isn't very much. It should have had something, but they're moving tick for tick perfect. So um, it doesn't seem like it. Probably because I just added it. It might be because I'm on the web version, maybe, but I doubt that. But if you only run analysis on the contract that you have and you're running a big picture analysis like a daily or a weekly, that missing data can screw with you. So, just to try to help you stay as consistent as you can, you're better off running your analysis off of the continuous contract. We can see I don't go over to the website much. I put in a lot of effort over the years to be able to trade on Tradeovate. Um, I was on Thinkorswim for so long that when I first got over to Tradeovate, I was like, "Oh, this sucks. I hate it." And I didn't like trading here at all. I would use TradingView as much as I could just so that I didn't have to trade off the platform. But eventually I got to the point where I was like, I don't want to have to do that. I still do most of the time, but I didn't want to be forced to do that. So I put in a lot of work to get to the point where I could trade on Tradeovate if I want to. I still don't do it because TradingView is really cool, but there's times where the connection just isn't good, or I'm kind of in a hurry and I just jump on and do what I need to do from here. So if you don't use the platform very often, you do want to get to the point where you can. And if this is all you use and you're not using Tradeovate, well, I mean, that's fine. You don't need to. It's got some really good tools built into the platform. Tradeovate used to work with Jigsaw years ago. The Jigsaw tools were a part of the platform. One of the things that came out of all of that is along the way, Tradeovate built a lot of those features into its platform. It's one of the reasons that Jigsaw left. So you've got some order flow tools that are kind of subtle, but they are there, and other brokers don't have them, or they want to charge you for them. And if you go over to TradingView, then of course you give those up, right? Because they're not built into TradingView the way that they're built into Trade Ah, well. So the at sign. Hey, what's going on? Yeah, yeah. Oh, yeah. Yeah, there's always a little bit in there. Yeah, it's hard to say. We are working our way through the the bulk of the earnings now are behind us. But with the tariff decision looming and this threat with Iran on the table, it's really hard to say what we're going to get. We've been in this range for so long. I keep waiting for the market to just wash out, shake everything loose, and start fresh. To me, that seems like the more likely scenario out of the two. When we think about eventually leaving this range of, well, where are we going to go? Are we going to break higher or break lower? We could certainly break higher when we finally do leave the box, but I just got this sneaky suspicion that we're going to end up breaking down, washing everything out, and then breaking out. But of course, price can do whatever it wants. Yeah, I've dialed back so much of my trading. I lean a lot more on the futures in the last 6 months than I have in my entire trading career. Just avoiding all of the shenanigans as much as possible and all the chaos out there. This administration made it clear that they want the chaos. They do things to deliberately provoke the dollar to make bonds move and yields move on purpose, just to shake things loose, leave people hanging, deliberately cause chaos. I don't see any reason to try to fight the system when they are going out of their way to mess with people like that, and just step farther away and farther away from equities because it's not worth the risk to me. As long as I can still provide for the family, then it's all good. And futures continue to take care of that. Yeah, being in the office for most of the day, I was in the office for most of the day and most of the night. And that's finally when the family drew a line and said, that's it. We don't ever get to see you anymore. So now I do 12 hours and I'm done. I get out of the office. Yeah, definitely. When the market's giving you an opportunity, you should take complete advantage of it. It's gamblers think they have hot streaks and cold streaks, and when they're on a hot streak, they don't want to stop. I don't necessarily feel that because I'm not a gambler, but when the market is giving you really good, clear signals, man, w- keep taking them until the signals stop. Yeah, no, there's some great swing trade plays that that I like. We haven't had the kind of setup that I'm looking for, but it matches the 786. I guess I should have drew that in a different spot where there's no price. We'll just move this for a moment. So what I like, I put the chart on a 15-minute and I look for multiple days of a drop to the downside and then at least an entire Globex session or even an entire RTH session where we're sitting inside of that 786 and we build this sort of a bear flag formation. And it can wick above and it can wick below. It doesn't have to stay perfectly in that 100 to 786, but that's the zone we want price to be in, and it forms a bear flag. It's just the normal bear flag. But instead of it following through like it normally would, we're looking for that failure where it starts to run back the other way and it ends up forming a really big cup. Maybe we get a handle, maybe not. But this was a trend of 2 or 3 days to the downside, and we're looking for the same 2 or 3 days back up the other side after spending some time in the middle. And that's the idea behind it. So, from a swing trade perspective, you can get 2 or 3 good days on a run back up, and it all starts while we're still in that base. And if you work on it, knowing that that's what you're setting up, then it's a game changer because I'm not a fan of getting 2 hour trades and 2 day trades, 2 week trades in the futures because normally I just want to get in, get mine, get out. Unless I know before I get in that I'm going to be in for 2 hours, 2 days, 2 weeks, then it's an entirely different thing. But without that mindset from the get go, knowing in advance that I want to be there for as long as I can, then I don't even try to stay in like that. I just get mine and get back out again. So it's all in the workup on what's the plan. And I struggled with this for a long time because of the pullbacks. If the plan is that I'm going to get in and run it back over a 2 day period, I'm willing to hold a 50-point pullback as long as it's not putting me in the red 50 points. It's just taking profit that I may have made. But if I don't know in advance, I'm willing to hold for 2 days and I'm looking for, 700 or 900 points. There's no way I'm going to hold through a 50-point pullback or a 90-point pullback, right? Take this short that we had over this 4 day period. If you knew you was going to go from 7,000 to 6,800, that's a 200-point move, you would probably be willing to hold 50-point pullbacks because you have this broad destination in mind that we're going to make our way into a deep trough and that it's worth all of that missed opportunity. Since we got in way up here, it never put us in the red. These pullbacks was just threatening profit. They weren't threatening our account. But no way whatsoever would I hold through those kind of pullbacks unless I had that bigger perspective of, oh yeah, I'm looking for this thing to really sink down and those pullbacks are acceptable. That is what the trouble was when I was trying to trade those kind of moves without thinking it through in advance. Like just catching a nice reversal off the highs. You're like, woohoo, that's a hell of a run. And it sinks down really fast. And we decide, well, screw it. I guess I'll just stay in and see how far I can go. As soon as we started to get a really deep pullback, I'd end up puking that trade out because that's a serious pullback after what I had just accomplished. And I wouldn't want to give up that kind of gain. So inevitably, I was getting myself out of a trade before getting these kind of returns. There had to be a way to solve that problem. And what I came up with was knowing in advance what's the purpose of this particular trade. just to catch a run and see how far I can go, or hey, I'm taking a swing trade here and I am expecting this level, and this level. Much broader ranges than my typical targets. That helped me rationalize holding through those deeper pullbacks. I won't hold into the negative that way. I don't hold 50 points red, and hell, I don't even hold 20 points red. Those extra tools are really awesome. I think they'll provide some great insight, but they won't stop what happened last week from happening again. The revenge trading, the 30-point loss, those didn't happen because you didn't have the proper tools. Those happened because you didn't manage your trade. Revenge trading is hard to break. I I have done it. I can't think of anybody who hasn't yet. And if you're listening and you're thinking, well, I haven't done it, give it time. You will one of these days. It sucks. I think at some point we all experience it, but you got to get to the point where it rarely happens or never happens anymore. Then you know you're on the other side of that drama. But there's always another drama to deal with. Revenge trading, get rid of that because it's just going to destroy you. There's this old wisdom that talks about after a big win or a big loss that we should shut it down and not continue to trade, which goes against all our instincts because when we get a big win, we want another one. And when we get a big loss, we want to go in and try to make back that loss. But it's better to just shut it down and walk away and try to figure that loss out. We can analyze things, we can research, try to try to figure out what's going on, but we don't want to try to make the money back. We don't want to try to duplicate the trade and get another one after a big win or a big loss. It's really time to just stop because those emotions are raw and bad decisions get made. It's like PTSD. It's a bad time to be making decisions. Well, they are right. The indexes are mean reverting, but um, I've I've had so many conversations with traders on this, and I've watched one of my best friends blow his entire account, his entire life savings. He lost his company because he was a small business owner. He lost everything because he had been trading options and stock, and they do come back a lot. If as long as you can hold through the pain, they come back. He got into futures and tried that. Unfortunately, it was February 2020. That was the COVID drop. He got wiped out. It didn't bounce back fast enough. You know what I mean? Like we fell for like a month and a half before we finally turned around, and it destroyed him. So that kind of logic just has never suited me. Even though even if you look at COVID, we did come back, but couldn't hold long enough, couldn't hold deep enough, couldn't hold through the shock of it. Like, yeah, that's what happened to him. They He couldn't hold it anymore, and they asked him to pony up more money, and he didn't have any more to pony up. Blew him out of the water like 9 or 10 days before we finally turned. But he knew it wasn't the broker's fault that they wanted more margin. It was the position that he had put himself in. The whole idea with loss, um, there's a couple of schools of thought that says, well, we should exit the trade A, B, C, D, E. A would be we should exit the trade when we can see that we're wrong. Well, in futures, that may be more money than you're willing to risk. To be able to say, for an example, I got in at 2 o'clock in the morning and I set my stop up above the 50 levels. So that's 26050, be like somewhere up here. I put my stop up there, and I would say if we got that high, my short's probably wrong and I can go ahead and get out. All right. Well, if that distance is farther away than I'm willing to risk capital wise, then I can't use that stop. If we were using something like price action, I could say something like, well, if I got in to go short at 2600 here, I could look back and put my stop here and say, well, I'm short. And as long as it doesn't go higher than this last high, then maybe my short is still valid and I should hold on. But if it breaches that high, then I'm wrong and I should probably get out. Even that distance might be too much. So trying to use price to determine if our trade is still valid doesn't work that well in futures because where it might not be valid is so far away, we can't afford to wait for that sort of validation. And so we need some other reason to get out. So then a lot of traders choose option B. And option B would be I'll just use a particular size of a stop loss. how much money am I willing to risk per trade? And they'll come up with a variety of ways to determine how big their stop should be. Maybe they use just a straight up dollar amount and say, I don't want to lose more than $50. Okay, $50 is how big my stop will be. Well, in the NASDAQ, that's 2.5 points. In the futures, ES, that's 1 point. $50 doesn't get us far. We could go to micros, and of course, that gives us more room. But that puts an arbitrary line in the sand. That line might be above the previous high. It might be right in the middle of a liquidity zone for all we know, but it'll be that $50 value or whatever value we choose. And that's where it's going to kick us out. There's more choices besides A and B that we can evaluate the trade as it's unfolding, recognizing, does this look familiar? Does it look like the trade that I thought I was going to take when I took it? Or is it turning into something that doesn't resemble what I had in mind to begin with? At which point we can just get out of the trade. We can bring in tools like order flow and all of that stuff and try to convince ourselves that we can see what's happening and see the strength picking up to encourage our trade, or the strength is failing and the trade is turning weak and we're losing our position. Different ways to evaluate. There's no right answer to this. Everybody's got to decide for themselves what they want to use. The worst decision is to not have one at all, and we're just winging it with no real way to determine, where the hell am I supposed to get out of this trade? And we take the trade anyways without having that answer. That's the worst one. So even just picking some form of an exit and sticking to it would be better than having no exit law at all. If anybody's in paper and they're struggling with this and you want to get better, a great exercise is to force yourself to use a tighter stop. There's no tight enough. If you're using 50 points, use 40. If you're using 40, use 30. Just use something smaller than you're using now because it's paper. What do you care? The idea would be that you can learn to use a tighter stop, bringing in order flow, reading price. Like, there's ways to get better. But if you leave it wide in paper and you never practice on trying to use a smaller stop, well, I mean, you'll never get smaller because you're not working on trying to get it smaller. I like to try to hide behind the orders on the dome when I can. That's not my only solution to things, but when I can get away with it, I try to do that. Um, I also have a fixed dollar value that I won't pass. Um, that ties in with risk to reward, but not 100%, because I don't want risk to reward to make all of the decisions for me. But it is a factor before I even go to get a trade. So this is the NASDAQ. There's plenty of room between this high and this low. So that if I was looking at this and thinking, can I run this price back up here? I would have plenty of room. There wouldn't really be much of a discussion. But what if it was a really narrow range, right? What if this range was only 8 points? Well, I probably wouldn't try to trade that range from the low to the high if it was only 8 points, because there's not enough room in here for me to get my money and have a stop, unless I think that I'm such a baller that I could hit tops and bottoms on every trade every time, which is kind of unrealistic. I mean, I'm a decent trader, but hitting tops and bottoms all the time is a bit out of my reach. So I like to evaluate before I even get in if there's room for me with my average stop to get the kind of risk to reward that I want. Doesn't mean I'm going to get it. It doesn't even mean I'm going to stick around long enough to achieve it. But if I can't even see a path to getting that kind of risk to reward, I don't even want the trade. The ES in this tight of a range kind of highlights that. That's a 20-point range. If I don't think that that range is going to offer me anything good, right? Because it's 20 points, but I would have to get in at the absolute top and make it to the absolute bottom, or from the absolute bottom back to the absolute top to get all of that. Can I get 5 out of 20? Heck yeah, I can get 5 out of 20, but it's sloppy, nasty price action. It doesn't look very clean at all. And it's starting to get messy. There's no pattern, there's no setup, there's no opportunity. All I've got is this random range that earlier in the day wasn't so defined. I wouldn't bother with it because it's sloppy trash and it doesn't look like my trade. But if we were going to trade this, where's your stop go? You can go in the past and you can work that out, because any new trade that you take, it should look like a trade that you've already got studied. That way you know what it looks like. The good thing is in the pre-market, I already had a pretty strong idea that today was going to be trash. And so I didn't spend a large part of my day trying to set up a trade because I had already expected it was going to be worthless. The worst that was going to happen is I would have missed a great trade, right? Like that was the worst that could have happened. And instead, I didn't miss a trade. I didn't even struggle trying to get a trade because today was expected to be just as trashy as yesterday was. I highlighted this. Yeah, I gave up on FOMO a long time ago. And without that FOMO driving me to hunt down unreasonable trading opportunities, then I just get to be really picky. The thing is, it's self serving. It really is. When you get a great trade that you identified in advance, you mapped it out perfectly, you executed it flawlessly, you make money, it feels good, and you're like, oh man, I want to do that again. That felt so good and it worked out so well. That was just so awesome. Let's do it again. When you get a couple of those, and then you get some sloppy trash crap and you're struggling with it and you feel just dirty afterwards, you're like, the trade sucked. That trade sucked so bad. And you compare it to what the other one felt like, you start doing what feels good and you lean towards that just naturally. And next thing you know, you're not even taking that trash stuff anymore because one, you didn't like the way it made you feel. Two, you don't like what it does to your account. Right. And three, the good one pays better and you really start growing. It just snowballs. Yeah, that event bar, it did guide us on that upside reversal though. I didn't say it enough in pre-market in my morning briefing, but those event bars, you really want to use 1.5 and 2.0 and look at the reversal off the 1.5. And that tip works when you see candles falling like this today when we were red and falling hard, those that's an event that's taking place. Broaden out your quadrant lines to bring in the 1.5 and the 2.0 because that sort of liquidity very often will run right through the 111 and the 1236 because those levels 111 and 1236 is for normal price. Event bars are emotions and news and traders caught on the wrong side, so we get big push. We want to use bigger numbers. Yep, that's exactly right. Correct. Yep, but I you caught it, but I bet a lot of people didn't, and I should have spent a little more time on it in the pre-market. Yeah, I'm gonna end up having to do it tomorrow because I had someone in the stream who was asking me questions, and then after the stream ended, they continued asking the questions like, "Well, what are we supposed to do with it? You know, like when are we supposed to get in it?" And of course, they're not traders, or they wouldn't have been asking that. But the answer was, if you don't know what those look like, then you shouldn't do anything with it. Just use it for analysis. Go back and find examples of it. The same thing I talk to you guys about all the time. And it doesn't seem like he was really happy with that answer. So I figured tomorrow I'll be touching on it again and highlighting this half because that is where we reversed. That's a damn good job. Got to get it when you can. So, a lot of the things that I see people struggle with, it's there's no outside answer. It's just things that they have to come up with on their own. And those event bars kind of are one of those. Like, I was trying to talk to the person about it. He was like, "Well, what are we supposed to do with it? How do we trade it?" He's like, "Well, what are you? Are you a scalper? Because if you're a scalper and you get that big event bar, then you could be aggressive and scalping it as it's alive. You don't even have to wait for that 5 minute to close before you're in there trying to grab some of it, and then even if you let that go by and you let the 5 minute close and then you mark the levels, if it's still running to the upside after that, then you would run it using the quadrant lines that we do, the 786 and the 111 and the 1236. And as long as your chart's on a small enough time frame, then you can run that. But you still have to decide, like every trader's got to figure out for themselves how they're going to take that kind of trade. A lot of people, and certainly not from somebody else's answer. One thing that I said to him today that shut him down was, I said, I don't even trade in that window. Like between 8 and 10, I'm not even looking for trades. It's not that I don't, it's not just that I don't trade in that window. I don't even look for an opportunity to trade in that window. I have no interest whatsoever of trading between that time frame. And really it's less than that. It starts at 7 because I'm done at 7 and then I do the morning briefing at 7:30 and that runs to around 8 and then from 8 to 10. So I'm not trading in that window anyways, no matter if I have an event bar or not. I don't care to trade the open at all, not even a tiny bit do I even bother with the open. And so when I told him that, he's like, "Well, what did you even show it to us for?" I was like, "Well, because you can use that candle to do your analysis, to lay out lines and levels and anticipate price. And at the bare minimum, maybe you won't go long at 9:30 because we had this big breakout at 8:30 that went up. Like how many new traders out there would try to go long at 9:30 because we had a big green bar at 8:30? Yeah, you don't want to get don't get Yeah, and that's what I was trying to get him to understand is because he at first he was frustrated and he was like, "You didn't answer me in the stream." I'm like, "Well, the stream's not a Q&A session. It's the briefing. I get in, get out, get started with the day." But the second part was it was such a vague question from someone who obviously isn't a trader that I could have spent 4 hours talking to him about it, and he still wouldn't have had an answer that he wanted because he just wanted someone to tell him, okay, when we get this big event bar, it's going to be green or it's going to be red, and you need to go long here or you need to go short here. And I didn't give him that, and that's where he was frustrated. That studying trick I have found to be so useful. If there was anything better, then I would certainly point it out to people, but it is the most effective way for people to begin to trust their ability to find the trade and trade the trade. And I think a lot of people are just missing that trust in themselves and that trust in the trade. They end up getting out too soon. They hold on to losers too long because they don't trust that they're right. They don't trust in their ability to analyze price. They don't trust the trade, and they make decisions based on that lack of trust. So by going in the past, finding the examples, studying the trades, knowing what they look like, and then planning to see it again in our live trade, to me, that's where it all comes together. I spend more time than that on one particular strategy in my playbook. So I don't think you're cooking it too long at all. Here's an example though of how I like to do it. Right? So this is yesterday's 111. It's one of my favorite trades. The 111 trade doesn't have to be 111 from yesterday, but the one this particular one is specific to yesterday's price. So it's not like I'm using a micro 111 or anything like that. This has to be off of yesterday's price action. So I go in and I set my chart to a 5 minute. I put like 90 days on it and I scrolled all the way to the left until I didn't have any more days to go. And then I started running slowly to the right. And I got to July 23rd and I marked the previous day's price and the breakout. And that's all I did this and then I moved on. I saved so that I could find it again later. I can see the date. I got everything I need here to find it again in the future. And then I moved on. Now, in this particular case, the next thing that I moved on to happened to also be July 23rd, because now I've got a 111 and a 1236 that's measured inside that day. So the first picture we was looking at was, hey, price reversed off of yesterday's 111, right? That's what this picture was telling us. That 5757 was the 1236 of yesterday. And the next picture said, yeah, but it was also this measured move into the 1236, which is 5755. So I had two different 1236s telling me that that was my reversal, and then to set me up for my opportunity. Now I know this trade. It's my favorite trade. I know the way the high is supposed to look, or the low if we flip it over. I know what kind of reversal pattern I'm looking for, a 2 bar or a 3 bar that I really like. And this is not it. This is just like some sloppy crap up there. But it's also before 10:30. And that's kind of what I expect out of price if it's before 10:30, that it'll be wrong in some way. And this is wrong. Now, here's another example of yesterday's high, yesterday's low, a 111 and a 1236. And I've got the date on it so I can find it again in the future. I went through an entire 90-day session doing just this, just scrolling a little bit so I can see the next day, snap my levels, take a picture if there was something to take a picture of, and then I move on to the next one because I wanted to study this setup and I need as much information as I can get to study this one thing. Now, of course, we are talking about taking a reversal trade. So outside of this, I need textbooks, videos, history on reversal patterns like a 3 bar, a moving star, a morning star, evening star, dojis, any sort of reversal pattern that I start to recognize that might be here. Because I want to tie that sort of school logic with the reality of what I'm witnessing, which is a reversal trade that I want to take. So I got to marry those two bits of information, but I need the actual trade. Like, what the hell does it look like? Because when I go to trade this in the future, I need to know what is it that I'm trying to trade. If I can't recognize it, then how am I supposed to find it? And if I'm in it, how do I know when to get out if I'm wrong? Unless I know what wrong looks like. So that's just a little bit of work, right? I set the chart, I scroll back, I find a day where price broke outside of the previous day, and I just snap a drawing and then take a picture and I move on and I go back afterwards to study this in more detail. So if you wanted to do the same thing with a different trade, then you would need to apply those tools. Say it's a RSI or a MACD or order flow or whatever it is. The order flow is going to be tricky because you need it to be happening when you take the picture, but you get the idea. You need to find those details so that you can get an example of it and then gather as many examples as you can gather so that you have something to work on. I'm a visual person and I'm a hands-on person. I gotta get my hands on it. So notes are okay to point me in the right direction, but they won't visually get me where I need to go. I gotta have the images. That's me. If you can do it in notes, great. Write yourself a book. Write whatever it takes. But to me, I needed something that I could physically adjust. So price action, and I needed the visual cues, so the pictures. Well, Statistical trading is really awesome when you have options. For me, statistical trading was never good enough for futures. And I've talked to people who wanted to know numbers like, hey, how often does your yesterday's 111 happen? And how often does it succeed versus fail when you actually do get one? They wanted all kinds of numbers. And like, how did you know that that was a good strategy? What's your back testing results? And on and on and on. And I didn't bother to get any of that. I knew it was a trade that I wanted to focus on because I already had a 111 strategy. It just wasn't quote yesterday's 111. But I already knew the 111 trade. I knew what it looked like. I knew how much I liked it. And I started applying it to the yesterday price because it was just something that I kept witnessing. I knew it was happening frequently enough that I was like, dang, this is pretty awesome. It's happening quite a bit. And I took a concentrated effort to focus on that one thing. But when it comes to a trade strategy, statistics are not enough to get me to trust it. The only thing that matters in statistics for me is how good am I at being able to trade it? So my results, right? I have less than 70% win rate. It's like 66, 68. It depends throughout the year. It'll bounce around. It doesn't get below 65, but I can't keep it above 70 either, which means I lose around 30% of the time, 32, 33. And those are my odds at all of my trades combined. I didn't go in and break it down and say, well, how many of these 111s from yesterday do I win versus how many of those do I lose? I didn't do that. I don't think I'm really interested in doing that. But the odds on how often does it show up and how often does it succeed when it does show up, how often does it fail, that wasn't enough to convince me. If that works for you, maybe look into Edgeful because they've got a lot of statistics on all kinds of things like that. They might have something that can help you. They are a numbers place. True that. Yep. Um, to me though, those odds were not a good enough reason for me to focus on a trade. It's funny, the moving average bounce or a VWAP bounce or a VWAP play, those have really high statistics. And yet I don't like them. I'll trade to a VWAP. I'll trade to a VWAP all day long. I love that trade. But interacting with a VWAP? No, hell no. I don't ever trade that. And yet it has good numbers. The stats are there, but the numbers just aren't good enough for me, right? Because I'm a numbers guy. I love options because of the numbers, but they just can't convince me to pull the trigger in futures. And the odds, like how much money am I willing to risk versus how much could I make? I the numbers just don't do it justice, but price itself, knowing how price behaves and watching it in real time to know what my trade is supposed to look like, that helps because my stops, I don't hit stops very often. When I'm watching price and it starts to misbehave, I just get out. I don't care. Like, well, okay. Oh, shoot, I got out. And if I had stayed in, I would have made 900 points. I don't give a damn. I really don't. Like, whatever. I got out because it was acting janky and it wasn't doing what I thought it was supposed to do. And I left. And then it ran away without me. So what? It took a while to get to that point. I got to say, I wasn't always so nonchalant when it come to getting out of a trade and then watching price run. But nowadays, I don't care. I really don't. If I miss it, I get out, I preserve capital, it ran away without me. I don't, whatever. Bye bye. And besides, I can get back in. It's not like I have to sit out. But stressing over the fact that I got out and it ran away without me, I don't, no care. Yeah, the psychology books are really eye opening. They say that people would rather try and lose than miss the trade and not make money. That that is surprising. People would rather lose money and say, "Well, at least I tried. I didn't miss it. I tried." They would rather do that than sit out or close the trade and watch it run away without them. They would rather take it and lose. And that's really shocking, but that's the reality is there's less pain to people on average, certainly not me, but that's what the psychology books say. People would rather have tried it and lost than to miss an opportunity to try. Yeah, my approach certainly fits that category. You know, that if I'm looking at price and it's starting to misbehave, I'm out of here. I'm not sticking around. You know, when it's one contract or two contracts, then, we can shrug and say, "Oh, heck, might as well leave it on, see what we get. I'll give it a little more room." I'm guilty of that. But when it's 12 contracts, 15 contracts, no, no, I'm not giving an inch. If it starts to even look at me sideways, I'm out. And the thing is, a lot of those things that we're discussing is conviction. Traders' conviction, where they decide, this is what I'm going to do. And that's what they do from then on out. It's not right or wrong, good or bad. It's just they finally made a decision. They like choosing what time frame you want to trade on. It's the new trader question, right? Every new trader from me to everybody I've ever met is, "Hey, what time frame should I put my charts on? I want a day trade. What should I use?" I asked it. I'm sure every one of you asked it. And unfortunately, nobody can tell you what time frame you should use. The only one who ever can make that decision is you. And there's no wrong answer. But we all were looking for someone to tell us at the beginning, "Hey, what's the right time frame to use if I'm going to day trade?" I'm so convicted, I don't even second guess for a second what my charts should be. I have often traded the daily candle in futures. People laugh at that, but I mean, I spend a lot of time on the daily. And when I see the setup like breaking out of yesterday's high, and I already know that I'm going to be reversing, like there's the breakout, and I'm watching the dome, and I just trade it right there off the daily. I know you was, but I've gotten so much feedback from that when someone's like, "I was asking you a serious question," and I'm like, "I know, but the daily is my answer." So, I posted a trade. Oh, I'd have to dig back and look for it, but I posted a trade and someone DM'd me and said, "Hey, what time frame was that trade on?" And that was my answer, daily. After I also said in the same answer, it doesn't matter what the time frame was. You can trade it on whatever you want. I was on a daily, and man, they thought I was being funny and they got a little salty, but I wasn't being funny. I was on the daily. I'm looking at this picture from the chat. You can see the event bar at 8:30 today, and then the breakout above it. All the fib lines, all the fib levels are over here, and this is different than mine because of the 618, which is the true fib, by the way. All right, it's the honest to goodness, real deal. I don't use it, but I love to see it when other people are doing a style different than mine. That's this person, for anybody watching the replay, they use this number often, so that they're not randomly picking it out here. Is just an interesting approach, which highlights that you can take a strategy and make it yours. And they did that by adding this, and it works. That's perfect. Absolutely perfect. For me, it's just the wrong time of day, and my I don't see my setup in there, but I love that it works. You knew the event was coming though, right? Yeah. Yeah, I wasn't quite sure what we was going to get out of it, but um I had that feeling, which is why I went over liquidity bars in the morning briefing, cuz I had that funny feeling that we were going to get a mover today. Now that we're past it, hopefully we can get something done with the rest of the week. Come on, Thinker Swim. Oh, I'm still in draw mode. It wasn't reading what I was doing. So we're still in the box for the week. We're still IX10 inside of Monday's range. So now that we're done with non-farm payrolls, maybe we can get this expansion and either cut Friday's low and then start running rabbit towards the bottom down here, or we can get above today's high and start pushing for the weekly edge up here, 70.54 or 68.40. That'd be a nice way to end the week. My concern is this lower low, and we haven't resolved this yet. I thought today that we were going to resolve it and I would be able to mark a lower high here, but I can't yet because we didn't close at the bottom down here. If we had done that and this was a red day that closed down at the lows, I could have gone ahead and marked it. But we're still closing in this zone, and that means I can't mark this as a lower high yet because it's just not resolved. And that means we could run up and set an equal high or a new high before it's done, and If I mark it as a lower high now and then we run up there, it's going to break everything. So for those that are catching this on the replay, there's things that you're going to have to work out as a trader that really nobody else can give you the answers to. And that doesn't mean you shouldn't ask, because it will at least help us focus you in the right direction. A lot of things that we have to choose as traders, it usually comes with a range of choices. And if you don't know what the choice selection is, then how can you pick one? Right? So at the very least, ask the question anyways. For an example, what time frame should I trade on? Obviously, you could trade a 1, a 2, 3, 4, 5, 10, 15, right? There's a lot of choices, but that's a pretty obvious selection of choices. But there's other things like, well, where should I enter a trade? Should I wait for the candle to close? Should I wait for price to tag the line? Right? Like, there's only so many ways to do it. And if you don't know all the choices, then you might not know what answer you want. But someone else can't tell you what you need to do. We can just show you the choices, and then you got to pick the one that you want out of the list. So ask anyways, but really concentrate on the fact that the final answer is going to come from you. It's not going to come from somebody else, or at least it shouldn't come from somebody else. Um, Sophie, when it comes to how do we know, we don't, right? So I'm just going to snap a level here. It's not going to be the 618 probably, but that doesn't matter, right? Like any level's a level. When price comes down into a level and we're looking for that reversal here, for an example, when price round tripped, came back down and tagged that 111. I look for 111 reversals all the time. I love 111 reversals. And this is a 111 reversal. Now, granted, it did come back and go lower, but how do we know? We don't. We just got to work with what we have. I know from extensive research that breakouts, if they're going to fail, very often will fail on a 111. So that doesn't say breakouts fail. That doesn't even say breakouts are going to fail at the 111. That just says that when we do fail, they very often do fail on the 111. So when we come down and we get this double bottom setting up, my expectation is that we're going to break the low that we already had, and we're going to go lower. And that if we do reverse, it very likely will be off of that 111. And then I try to gauge if I have a trade in that this time, because that could have happened at 940 and I wouldn't have traded it, or it could happen in power hour and I wouldn't have wanted to trade it. The candles could have been different than this, maybe tighter or really big like these, and I wouldn't want to trade it. So how it looks, where it is, when it happens, so many of those things are a part of the decision for whether or not I actually want to trade it. But we never know for sure if price is going to do something. We just we want to study what has happened in the past and try to get a gauge for what is most likely to happen next time in the future, because that's technical analysis 101 at the end of the day, right? Unfortunately, that's all that it is at the end of the day, is us just trying to recognize something that happened in the past and trading it, making money on it. Yeah, I mean, we know that the markets are manipulated, and there's a plunge protection team, and there's the Save a Ho group, and that they can come in and they can make price do a lot of stuff. But at the end of the day, for me anyways, my trades are all based on price action that has happened before, recognizable opportunities, whether it is as easy as a VWAP target or a breakout of yesterday's range or whatever it happens to be, that it's something I recognized frequently enough that I started to study it. And then from that, I started to track it, analyze it, and then it finally turned into a tradable pattern for me. I I went back and marked out Tuesday's run here from top to bottom, and we can see after that run happened. So there's Tuesday's high, Tuesday's low. We closed for the day, opened up in Globex, and we fought that half back. Now we got above it a few times, but we just wasn't able to keep it. Then we headed back down. We finally got a breakout of yesterday's low, and we tangled up in that 111, failed to really get deeper, and we came back out of it the other way. Now, this isn't one of those classic, beautiful 2 bar reversals or 3 bar swing lows. It wasn't one of those. It was an ugly, choppy, nasty reversal off of that 111 down there. But it's still my setup. I wouldn't have traded this one probably because it's not a very clean setup, but it is still the setup. And that's the idea. Everything is tradable as long as you can maintain your risk and you've got an idea of what's supposed to happen. Then you can begin looking for that to set up. I want to see my trade coming in advance. I want to be able to recognize it, preferably hours ahead of time. I don't want a trade that sneaks up on me where I suddenly look over at the chart and, oh, damn, there's a trade right there. Gosh, I didn't know that was coming. I don't want that at all. So take a trade like this yesterday's 111. I know where it is, and I know we're not going to get it until at least we break out of yesterday's range. So if we're sitting up here near the mid, well, I'm not worried about it. I'm going to, walk the dog, get lunch, do whatever it is that I want to do because we're nowhere near breaking out of yesterday's range. Now, once we start moving to the downside and we get reasonably close to 100, now I'm more interested in getting my trade set up. I've got plenty of time to go look at what the NASDAQ is doing and the dollar and yields and treasuries and the tick and the VIX. I'm in no rush. I can analyze other markets, check the news, headlines, what's been going on for the day, correlated markets, still no rush. And when price does finally get that breakout and get down into my level, I still don't need to trade yet because I understand that if we do get that reversal, bare minimum, we're going back to the one. If it's a solid reversal, we're going back to 786. And if we can get above that, we're going all the way back to the half. So I don't have to bottom tick this thing. There's no rush, no reason for me to, hurry up and make bad decisions. I got all the time in the world to try to figure out if this really is going to reverse off that low. And if this is going to be the low of the day, then I can start working on any of this move back up as my opportunity to get my 5 points, my 8 points. I want to find the highest conviction entry after that reversal. It doesn't have to be on the reversal at all. So we don't know, right? The best we can do is just try to identify where the opportunities should be and what they should look like. And then we work from there. Yeah, it's a good spot. It'd be a really good spot to hide that stop. Try to tuck it under as much stuff as you can hide it behind. A really good reversal pattern would have had me in this really quickly. but we didn't have a really good reversal pattern. Something like a morning star reversal or a big long pin bar, something like that, a beautiful 3-bar reversal. We didn't have any of that down here. Instead, we got down there and then we stalled out and chopped around for a bit. And once we hit that level, oh, I got a phone call. I've been waiting on this.